Look, I want you to imagine something with me real quick. You're at a dinner party, right? And there's this guy, let's call him David, who's going on and on about how he beat the market last year. He's talking about his Tesla options, some cryptocurrency play he made, how he got into Nvidia before it exploded.
And you're sitting there feeling kinda dumb.
Because you've just been putting money into a boring index fund every month, like some financial amateur. Here's the thing, though. Fast forward 5 years, and I promise you, statistically speaking, you're probably going to be richer than David.
And that's not me being optimistic. That's just math.
If you're someone who feels like you're not smart enough to pick winning stocks, or you've been second-guessing whether your simple investing strategy is actually working, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today, we need to talk about one of the most counterintuitive truths in personal finance: passive investing. Literally doing less, thinking less, trading less is absolutely destroying what the smart money is doing. According to the SPIVA scorecard, which tracks how professional fund managers perform against the market, here's what happened over the last 15 years. 88% of actively managed funds underperformed the S&P 500. 88%. These aren't random people on Reddit making stock picks. These are professionals. People with Harvard MBAs. People with Bloomberg terminals on their desks. People who spend 80 hours a week analyzing financial statements, attending earnings calls, building complex financial models. And nearly 9 out of 10 of them lost to someone who just bought an index fund and went to the beach. But here's where it gets really interesting. It's actually worse than that. Because that 88% number, that's measuring whether they beat the index at all. When you factor in the fees these active funds charge, often 1% to 2% per year, the number of funds that beat the market after fees over 15 years jumps to over 95%. Let me put that in real dollars for you. Let's say you invest $10,000 today. Over 30 years, assuming a 10% average annual return, that becomes about $174,000 in a passive index fund, charging 0.04% in fees. That same $10,000 in an actively managed fund charging 1.5% in fees, even if it matches the market's performance before fees, you end up with about $116,000. You just lost $58,000, not because you made bad picks, not because you panicked and sold, simply because you paid someone to be smart on your behalf. Now, you might be thinking, okay, but surely the really smart people, the top 5% or 10%, they must be crushing it, right? Here's what most people don't realize. Even if you could identify those top performers, it doesn't help you.
Because here's the problem. Past performance doesn't predict future results. Here was a study done by Dimensional Fund Advisors that looked at mutual funds that were in the top 25% of performers over a 5-year period. They wanted to know, do these winners keep winning? The answer? Only 23% of those top quartile funds stayed in the top quartile over the next 5 years. That's worse than a coin flip. You'd literally have better odds picking funds randomly. And this makes sense when you think about it. Because here's the thing about markets. They're competitive, really competitive. When you buy a stock, someone is selling it to you. When you sell a stock, someone is buying it from you. And you're both looking at the same information, the same earnings reports, the same news articles, the same analyst predictions. For you to win, the person on the other side of that trade has to be wrong. And when everyone has access to the same information, processed by algorithms that can analyze data in milliseconds, your edge, if you have one, disappears really, really fast. And when everyone has access to the same information, processed by algorithms that can analyze data in milliseconds, your edge, if you have one, disappears really, really fast.
This is what economists call the efficient market hypothesis. And look, I know that sounds like boring academic stuff, but here's the simple version. Stock prices already reflect everything that's publicly known about a company.
So trying to find undervalued stocks is like trying to find a $100 bill on the sidewalk in Manhattan. Yeah, theoretically it could happen, but if it's there, someone else probably already picked it up.
But here's where this gets really fascinating from a psychological standpoint. Because the reason smart people keep trying to beat the market, even though the data says they can't, isn't because they're stupid. It's because our brains are literally wired to work against us when it comes to investing. Let me explain what I mean. There's this cognitive bias called the illusion of control. Basically, we feel better when we're doing something, even if that something doesn't actually improve our outcomes. A study by Ellen Langer at Harvard showed that people gambling in a lottery were willing to pay more for tickets they chose themselves versus tickets that were randomly assigned, even though the odds were identical. This shows up everywhere in investing. We feel smarter, more in control when we're actively picking stocks, timing the market, reading financial news. It feels like we're doing something. Passive investing? It feels lazy. It feels like we're admitting we don't know what we're doing. And here's the kicker. That feeling is costing you a fortune. Then there's another bias called overconfidence. Study after study shows that people think they're better than average at pretty much everything, including investing. There's this famous survey where they asked professional fund managers to rate their own skill. 74% said they were above average. Mathematically, that's impossible, but psychologically, it makes perfect sense. We remember our wins and forget our losses. We attribute our successes to skill and our failures to bad luck. I saw this firsthand in 2021. Everyone I knew was suddenly a genius investor. People were making money on GameStop, on Dogecoin, on tech stocks that went parabolic, and they thought it was because they were smart.
Then 2022 happened, and suddenly all those smart traders lost 2, 3, sometimes 5 years worth of gains in a single year. Meanwhile, the boring index investors, they were down too, sure, but they didn't blow up their portfolios. They just kept buying. Look, here's what really drives me crazy about this whole conversation. When you actually sit down and do the math, passive investing isn't even close. It's not like active investing wins 12% of the time and passive wins 88% of the time. It's a blowout. Let me show you a real example. Let's say we have 2 investors, both starting with $50,000. Investor A, let's call her Sarah. She puts her money in a total stock market index fund. She contributes $500 a month. She never tries to time the market. She ignores the news. She just buys and holds for 30 years. With an average return of about 10% annually and fees of 0.04%, she ends up with approximately $1.13 million. Investor B, let's call him Jason. He's smart. He reads the Wall Street Journal. He watches CNBC. He actively trades, trying to beat the market. And let's be generous and say he actually matches the market's 10% return before fees, but he pays 1.5% in fees for his actively managed funds, and he trades frequently, creating tax drag of another 1% per year. So his real return is about 7.5% annually. Same $50,000 start, same $500 monthly contribution, 30 years. Jason ends up with about $697,000. Sarah has $433,000 more than Jason. That's not a rounding error. That's a beach house. That's retiring 5 years earlier. That's your kid's college education paid for in full. And remember, this scenario assumes Jason actually matches the market before fees, which, as we've already established, 88% of professionals can't do. Now, you might be thinking, okay, but what about taxes? What about inflation? There's got to be a catch. Here's the thing. Passive investing actually wins on those fronts too. With taxes, here's what happens. When you actively trade stocks, you're constantly triggering capital gains taxes. Every time you sell a winner, the IRS wants their cut. And if you held that stock for less than a year, you're paying short-term capital gains, which is taxed as ordinary income. Passive investors? They buy and hold. They're not constantly selling, so their gains compound tax-deferred until they actually need the money in retirement. And when they do sell, it's taxed as long-term capital gains, usually 15% or 20%.
There was a study by Vanguard that found this tax drag from active trading costs investors an average of 1.1% per year in returns.
That's on top of the higher fees they're already paying. And then there's the time cost. How much is your time worth? Because if you're actively managing your portfolio, you're spending hours every week reading financial news, analyzing stocks, watching the market. Let's say that's just 5 hours a week. Over a year, that's 260 hours. Over 30 years, that's 7,800 hours. If your time is worth even $50 an hour, which is conservative for most professionals, that's $390,000 worth of your time. You could have spent that time with your family, building a side business, learning a new skill. Instead, you spent it trying to beat an index that you statistically can't beat anyway. Now look, I can already hear the objections, because every time I talk about this, I get the same pushback. But what about Warren Buffett? What about Peter Lynch? They beat the market. Yeah, they did. They're also two people out of millions of investors. That's survivorship bias. For every Warren Buffett, there are 10,000 people who tried the same strategy and failed. You just don't hear about them because they're not billionaires.
And by the way, even Warren Buffett agrees with me. In his 2013 shareholder letter, he literally said that when he dies, he's instructing his trustee to put 90% of his wife's inheritance into a low-cost S&P 500 index fund. His exact words, "I believe the trust's long-term results from this policy will be superior to those attained by most investors." If the greatest investor of all time is telling his own family to just buy index funds, maybe we should listen. But what about technology? What about AI? Shouldn't I invest in the future? Here's what you're missing. When you buy a total market index fund, you already own the future. You own Apple, Microsoft, Google, Nvidia. If AI takes off, you win. If some new technology emerges, as soon as that company gets big enough, it enters the index. You automatically own it. You don't have to predict the future. You just have to own a piece of everything, and the winners will take care of themselves. But isn't passive investing boring? Yeah, it's boring. You know what else is boring? Getting rich slowly and reliably. This is where it gets really interesting, because we've been conditioned to think that investing should be exciting, that it should feel like you're doing something. But here's the truth. The best investment strategy is one you can stick with for decades, and excitement is the enemy of consistency. Boring wins every single time. All right, so let's get practical. If you're convinced, or even just curious about passive investing, here's exactly what you should do. Step 1. Open a brokerage account if you don't already have one. Fidelity, Vanguard, Schwab, they're all good. This should take you about 10 minutes. Step 2. If you have access to a 401k or similar retirement account through your employer, especially if they offer matching, max that out first. That's free money. Don't be stupid. Step 3. Choose a simple index fund. I'm talking about something like VTSAX, Vanguard Total Stock Market, or VTI, the ETF version, or Fidelity's F0ROX. These funds give you exposure to basically the entire U.S. stock market for fees that are almost zero. If you want to diversify internationally, add something like VXUS or FTIHX for international exposure. A simple 60-40 or 70-30 split between U.S. and international is perfectly fine. Step 4. Set up automatic monthly contributions. This is crucial. You want to remove emotion from the equation entirely. Every month, a set amount goes from your checking account into your index funds. You don't think about it, you don't time it, it just happens. Step 5. Never look at your account. Okay, maybe once a year. But seriously, the more often you check your portfolio, the more likely you are to panic and do something stupid. Step 5. Never look at your account. Okay, maybe once a year. But seriously, the more often you check your portfolio, the more likely you are to panic and do something stupid. Step 6. Increase your contributions every time you get a raise. Got a 3% raise?
increase your investing by 2%. You won't even notice the difference in your paycheck, but your future self will be incredibly grateful. That's it. That's the whole strategy. And here's the beautiful part. Once you set this up, you're basically done. You can spend the next 30 years focusing on your career, your family, your hobbies, whatever actually matters to you, while your money quietly compounds in the background. Here's what most people don't realize about wealth building. It's not about being smart. It's not about having secret knowledge. It's not about timing the market perfectly. It's about time in the market. There's this incredible example I love to share. Let's say there were 3 investors who each put $10,000 into the S&P 500 in 1993.
Investor A had perfect timing. Somehow, magically, they only invested on the single best day of each year to invest.
Investor B had terrible timing. They only invested on the worst day of each year.
Investor C didn't try to time anything. They just invested on the first day of every year, no matter what. By 2023, after 30 years, here's what happened. Investor A with perfect timing, about $176,000. Investor B with terrible timing, about $172,000. Investor C who didn't time at all, about $174,000. The difference between perfect timing and terrible timing over 30 years, about $4,000 out of $176,000. That's roughly 2%. Time in the market beat timing the market. Consistency beat cleverness. And that's the real secret that the financial industry doesn't want you to know. Because if everyone understood this, who would pay for expensive actively managed funds? Who would pay trading commissions? Who would watch CNBC all day? The industry needs you to believe that investing is complicated, that you need experts, that there's some secret sauce you're missing. But the truth is way simpler and way more boring than that. Look, I get it. Passive investing doesn't feel satisfying. It doesn't make for good stories at dinner parties. You can't brag about the amazing stock pick you made. But here's what you can do. You can retire at 55 instead of 65. You can sleep well at night knowing your financial future is secure. You can stop obsessing over market movements and actually live your life. Because at the end of the day, money is just a tool. It's not the scoreboard. It's not how you prove you're smart. It's what enables you to do the things that actually matter. And the fastest way to have enough money to do those things is to stop trying to be clever and start being consistent. So here's my challenge to you. Try it for 1 year. Set up your index funds, automate your contributions, and then don't touch anything. Don't check the news. Don't try to time the market. Just let it run. Promise you, a year from now, you'll be shocked at how much simpler your life is and how much better your returns probably are compared to all that smart people trying to beat the market. If this video helped you understand why passive investing is the way to go, do me a favor and share it with someone who needs to hear this. And if you haven't already, hit that subscribe button because we're going to keep having these honest conversations about money that nobody else wants to have.
I'll see you in the next one.